Hey everyone, welcome back to Corporate Decoder, the place where we decode those dense corporate filings to find the juicy bits. And today we're diving into Couchbase Inc.'s latest report to see what is really going on because, well, something pretty big happened. This is a big one, folks. Couchbase, the company we all know and love, has been acquired. That is right, it is no longer a publicly traded company. We are looking at a Form 8K specifically, which is used for announcing major events that shareholders should know about. And trust me, this is a major event. If you want to stay ahead of these market shifts and understand what they mean for the future of tech companies, join our Discord community. It's linked in the description below. Let's get into it. So the magic date was the 24th of September 2025. This is when Couchbase signed its final report as a public company. For years, Couchbase's stock was traded on the Nasdaq under the ticker symbol BASE. But as you will see, that is now a thing of the past. The main reason for this filing is the big news: the company has been bought out. It was a merger and acquisition orchestrated by Cascade Parent Incorporated, a company related to Havli Investments. Now, Couchbase is no longer independent, it is a wholly owned subsidiary. This basically means they are now part of a larger structure. To make this deal happen, 2 new credit agreements were put in place. Think of these as the financial plumbing that allowed the acquisition to proceed. There was a Holdco credit agreement for $150 million and an Opco credit agreement for a much larger $450 million. These agreements provided the cash needed to buy Couchbase and cover all related expenses. The Opco agreement even secured the loans against the assets of the companies involved, which is pretty standard practice in these kinds of deals. As part of the acquisition, Couchbase also had to tidy up its existing financial commitments. This meant paying off all loans and closing out any outstanding credit lines with Mufji Bank. When companies get acquired, these old agreements are usually terminated to make way for the new ownership structure. Now, for the part that affects the shareholders directly, every share of Couchbase common stock was bought for $24.50 in cash. That is the final price per S-share. For those who held Couchbase, restricted stock units or ASAs things were handled based on whether they were already vested or not. If the ASAs were vested, they were simply cashed out at that $24.50 per share price. If the ASAs were not yet vested, they were also converted into cash. The amount was calculated based on the usual award terms, but the future vesting schedule was kept almost the same, just with some administrative tweaks that did not hurt the employees. For performance-based stock units or SUS, the situation was similar. Vested SUS were cashed out at the $24.50 per S-share. Unvested SUS were also converted into cash, but with an interesting twist: they would continue to vest based on the original conditions until the 15th of December 2025, as long as the employee remained with the company. Any SUS tied to stock price targets above the $24.50 acquisition price were simply cancelled, which is a common outcome when a company is taken private above certain price thresholds. Stock options were also handled with care. Vested options were cashed out for the difference between the $24.50 price and the original option exercise price. So if you had an option to buy stock for $10, you would get paid the $14.50 difference. Unvested options too were converted into cash, but with a contingent right to receive it. They would follow the same terms as the original options, including any acceleration clauses if the employee was terminated without cause. Any options with an exercise price at or above the $24.50 acquisition price were unfortunately worthless and cancelled for nothing. Also, the employee stock purchase plan ended, which is another sign that the company was transitioning out of public ownership. As expected, after the acquisition, trading of Couchbase stock on the Nasdaq was halted and delisted. The Nasdaq filed a Form 25 to officially remove the stock, and once that becomes effective, the company will also deregister its stock, removing them from the SEC. As reporting requirements, they are not publicly traded anymore. This basically means that as of the acquisition date, shareholders no longer had any rights as shareholders of Couchbase. They only had the right to receive the agreed upon cash payment. This section confirms what we already know: a significant change in control happened. Couchbase is now fully owned by Parent, which is part of the Havli Investments umbrella. The total deal was around $1.5 billion. This was funded by investments from Havli, S-affiliated funds, and the debt financing we talked about earlier. As is common in acquisitions, the entire existing board of directors stepped down. This was not due to any disagreements, but simply a consequence of the change in ownership. However, 2 new directors, Brian Sheth and Sumit Pandey, were appointed to the board of the newly formed surviving corporation. They will be guiding Couchbase under its new ownership. The foundational documents of Couchbase, its certificate of incorporation and bylaws, were also updated to reflect its new status as a privately held company. These changes are mostly technical to align with the new corporate structure. Finally, Couchbase also released a press announcement to the public confirming the closure of the merger. This officially marked the end of its journey as a public company. And here at the end we see the list of exhibits providing all the legal documentation for this transaction, including the merger agreement itself. Now looking at the big picture, Couchbase was acquired for $24.50 per S-Hair, valuing the company at approximately $1.5 billion. This acquisition was funded by a mix of equity and debt from Havley Investments. For shareholders, this means a clean exit, receiving cash for their shares. For the company itself, this signals a shift from being beholden to public market pressures and quarterly earnings to a more private environment where long-term strategy can potentially be pursued with less immediate scrutiny. From an outsider's perspective, this is often a positive sign for a tech company. It suggests that a sophisticated investment firm like Havley saw significant value and future potential in Couchbase that perhaps the public market was not fully recognizing or valuing. The debt financing suggests they are confident in Couchbase's ability to generate enough cash flow to service that debt. The key risks for Couchbase now lie in its ability to execute its strategy under new private ownership. Will the resources and guidance from Havley unlock new growth opportunities, or will the pressure to manage the debt hinder innovation? The departure of the board and the integration into a new corporate structure are always critical transition periods. Keeping key talent, especially those with deep product knowledge, will be paramount to success. In conclusion, Couchbase's acquisition by Havley Investments at a $1.5 billion valuation represents a significant milestone. It is the end of one chapter as a public company and the beginning of another as a private entity. The market will be watching to see how this new chapter unfolds, balancing the opportunities of private ownership with the responsibilities of managing significant debt. What are your thoughts on this acquisition? Do you think Couchbase will thrive under private ownership? Let me know in the comments below. And if you found this breakdown useful, please give this video a thumbs up and subscribe for more deep dives into corporate filings. Don't forget to join our Discord community linked in the description. Thanks for watching, and I will see you in the next one.